All right, when you hear the phrase pump and dump, you're probably picturing some dusty relic from the 1990s, right? Boiler rooms packed with frantic brokers cold calling unsuspecting folks. But here's the thing, that's old news. Today, this is a highly sophisticated, modern financial heist, and it is happening literally right now on the digital platforms we all use every single day. Welcome to The Explainer. Today, we're going to break down the actual anatomy of a pump and dump. We'll expose exactly how fraudsters manufacture hype out of thin air to siphon money directly from the wallets of everyday investors. To do this, we've put together a bit of an investigation dossier for this explainer. First, we'll map out the anatomy of the scheme. Then we'll look at executing the pump, followed by the devastating dump. After that, we'll track its evolution in the digital age, and finally wrap up with spotting the red flags. All right, let's dive into Section 1, the anatomy of the scheme, defining the crime. So let's get one thing straight right off the bat. A pump and dump isn't just some aggressive marketing campaign or a highly speculative trade. No, it is a calculated scheme. What happens is fraudsters artificially inflate the price or even just the trading interest of an investment. They're basically building a complete illusion of momentum, and then they sell their own holdings right at that artificially inflated peak. The reality of this manipulation is brutal. It leaves the later investors, the folks who bought into all that manufactured hype, left holding the bag, facing massive losses when the price inevitably collapses. And look, this isn't just some minor market annoyance. Regulators view this as a severe threat. Take the Financial Conduct Authority in the UK, for example. They explicitly state that market abuse harms the integrity of UK markets, and they specifically call out pump and dump manipulation as harmful to investors and the appeal of those markets. So we're talking about a direct, full-on attack on global market integrity. Now, why does this actually matter systemically? Well, think about how markets are supposed to function. We rely on prices, on trading volumes, and on market commentary as signals, right? Signals of genuine value. A pump and dump scheme intentionally corrupts those signals. It creates this completely false appearance of momentum, or maybe insider knowledge, and that tricks market participants into trading on a totally distorted basis. It's essentially poisoning the well. Moving on to Section 2, executing the pump, manufacturing hype. Okay, let's open up the fraudster's playbook, specifically looking at how the European Securities and Markets Authority breaks it down. It's a distinct multi-step process. Step 1, the perpetrators quietly take a long position in the asset, getting in early, right? Step 2, they start buying, but more importantly, they disseminate misleading, overly positive information to drive the price up. And then step 3, this is where it gets really insidious. They manufacture an extreme urgency to buy. They absolutely need the crowd to rush in. But how exactly do they create that urgency out of nothing? Well, the pump can take a lot of different forms. We're talking false claims about a company's prospects, totally fake partnerships, or just highly misleading financial narratives. Or, and this is incredibly common right now, it's staged hype on online forums and heavily coordinated social media promotion. The entire goal here is fabricated urgency. It's pure psychological manipulation designed to trigger your FOMO, that fear of missing out, pushing you to buy in fast before the price supposedly goes to the moon. Which brings us to Section 3, the devastating dump, the getaway, and the damage. Here's the really harsh reality of it all. This entire pump was driven by rumors and false claims, creating a buying frenzy that literally wouldn't exist if the market had accurate information. And once enough demand is artificially created, boom, the perpetrators execute the dump. They sell off their positions and profit heavily at the direct expense of everyone else. That inflated price suddenly plummets, and everyday investors are left with sudden, frankly, crushing losses. To actually catch these schemes, you have to look at the whole picture. Effective surveillance demands linking two totally separate risks. On one side, you have the communications risk. That's your false promotion, the rumors, the wild hype on social media. On the other side, you've got the trading risk. That's the perpetrator's actual positioning, their buying, and their eventual selling. As the source material points out, if a regulator only looks at market prices, they just see volatility. They completely miss the coordinated promotion. But if you only look at the communications, you miss that the promoter is perfectly positioned to profit from it. You absolutely have to link the hype with the actual trading accounts to see the crime. Let's shift to Section 4, evolution in the digital age, the modern playground.
Traditionally, when we talked about this typology, we were looking at microcap and thinly traded penny stocks. Why? Because they're super easy to move with just a little bit of buying pressure, usually pushed via classic boiler room cold calling. But look at where we are today. The FC's current warnings show this is absolutely no longer confined to penny stocks. It has completely migrated to digital and online spaces. We're seeing it constantly in crypto asset markets and through coordinated social media campaigns. The channels have changed, for sure, but the underlying method of manipulation, exactly the same.
Today's schemes rely on a highly sophisticated global infrastructure that overlaps with broader financial crime networks. Just looking at the SEC's 2025 enforcement results, authorities are chasing down schemes involving foreign-based companies and gatekeepers. They're using offshore entities to obscure operations. They use paid touting, which literally means compensating people to aggressively push the asset. They deploy compromised, hijacked digital accounts to spread rumors, and they use incredibly opaque ownership structures just to mask exactly who is cashing in on the dump.
And finally, Section 5, Spotting the Red Flags, the Detective's Toolkit. Based on some clear regulatory warnings from both the SEC and the FCA, here's your toolkit. These are the critical warning signs that the market signal you're seeing is actually a manufactured trap. First, watch out for sudden surges in price or volume without any credible, fundamental news to back it up. Second, be super wary of heavily concentrated online hype or repeated, frantic buy now messaging. Remember, they are trying to fabricate urgency. Also, keep an eye out for suspicious promoter activity, trading that seems weirdly concentrated among connected accounts, and the rapid, sudden disposal of holdings the exact moment outside demand finally shows up.
To really sum that checklist up, the SEC's investor alerts offer a wonderfully blunt warning. Be skeptical of unsolicited hype and rumor-driven opportunities. Frankly, if an opportunity feels like it's being aggressively shoved down your throat via rumors, there's a very good chance you aren't the one who's actually meant to profit from it. So, the biggest takeaway from this explainer is understanding the ultimate systemic impact of a pump and dump. These schemes are a severe form of market manipulation. By manufacturing demand and artificially pumping up prices, they accomplish exactly one thing: transferring losses from the perpetrators straight to later investors. This completely undermines fair price formation and shatters confidence across both our traditional markets and the newer digital asset ecosystems. And that right there is exactly why strong surveillance and investor protection are absolutely vital. I want to leave you with a final thought today. The next time you're scrolling through your feed and you see this sudden, urgent, aggressive hype online, ask yourself one question. Are you truly finding a rare, once-in-a-lifetime opportunity, or are you just providing the exit liquidity for someone else's getaway? Stay sharp out there, stay skeptical, and thanks for tuning in to this explainer.